Taylor Media is my site where my radio show is posted. You can listen to it live. It's 12 o'clock to 1 o'clock Pacific time every Tuesday. Most people listen to it as podcasts the following day, which you can find at Taylor Media. And also, miningstocks.com is where my newsletter information, where people can subscribe. And also, I post a lot of information, links to different sites. Actually, the companies that are on my list, whenever there's any news for those companies, I post the link there so my subscribers or anyone else can really quickly follow up on the news releases. And also like to put links to articles that I think impact geopolitical or economic events that impact the price of gold, either directly or indirectly. So I want to talk today, I want to ask the question, why will this gold bull market likely continue? After the last few days, it's probably has a lot of people wondering. And it really depends to such a great extent on the real rates of interest. The direction of real rates of interest really depend on global economic growth, or GDP. So GDP, in my view, can only get weaker now, given the massive problems that the central bankers have created. Essentially, growing insolvency globally because of indebtedness, over-indebtedness relative to GDP, and also growing inefficiencies of the markets. Like, essentially, the central banks have been destroying capitalism by not allowing price discovery of capital. So by manipulating the interest rates, we don't really have a true picture of what cost of capital is, and so it gets misallocated in many ways. It causes long-term problems and inefficiencies in the economy. So I want to talk a little bit about the geopolitical forces that I think are going to really reduce the dollar hegemony over time. I think they're in force and they're happening now. And then I think really there's beyond, there's just limits to how far markets can go. So some market plate tectonics, as my friend Michael Oliver refers to them, really believing that the forces are in place for the start of a bear market in stocks and bonds and a bull market in not only in gold but commodities. And the commodities sector led by gold. Now recently I was at a conference. Well, it wasn't a conference. Newsletter writers were invited by Sprott Asset Management to go to Toronto, and Paul Wong, who is the portfolio manager, the senior portfolio manager there, gave a talk, and he showed this chart, which I think is really interesting in terms of most of us can relate to this. Bull markets for gold are very substantial. They run for a period of time. They, on average, have the last 7 bull markets have averaged 500% gains, but then they're prone to 80% losses or something along of that magnitude. So how do we know when to get out? How do we know when to get in, and how do we know when to get out? Obvious question. Well, Paul is pointing out that, by the way, that slide that I just showed you is it's the S&P TSX Gold Index, and so it's the shares. The slide I just showed you, I'm not sure how to go back. Yeah, so what we're looking at there is the S&P gold stocks, the S&P TSX, or Toronto S&P gold shares index. And so you can see those long runs that, pretty spectacular, but then extremely painful at the end of them. So the real correlation that I want to show here is this shows gold to the direction of real interest rates. So the real gold bull markets have occurred at least as real interest rates are in decline. And that's something I think the most important thing to keep in mind today. So what would cause real interest rates to decline, or what would cause them to rise? Well, Paul's idea is that it's just simply a rising GDP is very, very bearish for gold. And if you can make the case that the global GDP is going to start rising and growing, then if I could do that, I would be very bearish on gold. But I think the opposite is the case. This slide shows it shows the more that debt to GDP grows, the less GDP grows. So when the red line is the debt to GDP ratio, and you can just see, and the areas there show the growth, GDP declining from 3.8 to under 2% now. It's just been a trend that's occurring as debt grows relative to the economy, it's just lethal in the long run. Now, I put something together a long time ago because I really wanted to know whether the global economy was expanding or contracting, whether prices were expanding or contracting. And I put something together. It's just, it's a number of different equity indices. It has U.S. Treasuries in it. It also has commodities in it. So I wanted to get an idea of whether asset prices were expanding or contracting. And you see the sharp drop-off of 2008, 2009. And then the quantitative QE1, QE2, we see a jump up to new highs in my index. But then since then, for all of the trillions of dollars that have been pumped in the system, it's petering out. The global prices are not responding very well. What's held that up were the stock prices, which have done very well over the last couple of years, several years. But the commodities have not. So from the peak of the commodities cycle, it reached a peak, and I'm measuring it by the Rogers Raw Materials Index. It went to, by July 3rd, 2008, it reached a peak. From that time until the present, you'll see the various sectors in my IDW, my Inflation Deflation Watch. So you can see the sectors that did well. The housing stocks, because they were helped by artificially low interest rates. So you see the things that did poorly were the things that apply to the real economy. So you have copper, the Rogers Fund, which is a basket of all different manners of commodities, and then oil. And those have not done well. So it really, I think, is a big part of the Trump story, is that middle America, the people that produce stuff that actually increase wealth, have not been doing well. And there's so many reasons why the Fed can't really try to restrict the growth of money and let interest rates rise, because one is this U.S. debt. Now we're something close to $20 trillion now in U.S. debt. And soon after Trump comes into office, he's going to have to vote for a new debt ceiling, which is going to be very interesting. So we have this issue of now with interest rates. Actually, the average rate is around 1.5%. 300 billion, I think Jordan was saying it's something over 400 billion now, but this was just going back a bit here. It was 300 billion. So if we go to 3% average rates, you know, it doubles it. You go to 5%, you're up over $1 trillion a year just in debt service. So there's a powerful incentive for the Fed, not incentive necessarily, but a need to absolutely put a ceiling on the rise of interest rates. So I think the issue of the real interest rates, especially if, as I expect and some other speakers here expect, the inflation to pick up, and it actually is starting to pick up, then the real interest rate should turn to be more negative. Now, I think the Fed is really wanting to raise rates, so it has some ammunition, so it can go back with the next decline and try to loosen up. And I think it's been making an effort to. This is a 52-week global U.S. dollar liquidity growth, which was something an analyst at Merrill Lynch was measuring during the Asian crisis, and I started tracking it ever since then. And you can see this enormous. This really grows. It's a composite of the Federal Reserve's monetary base plus foreign bank holdings of dollars. And you can see the explosion after 2008, 2009, the huge amount of money that was pumped into the system. It actually had grown this measure at one point nearly 50% over the 52-week period of time. But now they're bringing it down, I think, in an attempt to try to restore confidence, to have confidence in the system, and to have that maneuverability when the economy goes in the next time we're in a recession. Now, part of that very interesting story, I think, and this is where I think the geopolitics comes into play, the declining influence of the United States dollar at the IMF and elsewhere. But you'll notice what this slide is it shows the percentage of that global U.S. dollar liquidity that is held by foreign central banks. So you see it fell off the table essentially with 2008, 2009 when the U.S. printed huge amounts of money and put it on the bank balance sheets, on the Federal Reserve balance sheet, and then it sort of fell off and then went sideways for a while, and now it's at a new low. It's been around since the last 3-4 years at about 45%, where it had peaked out at 72% before the housing crisis. And so I think this is just a measure in my mind of the waning influence of the U.S. dollar. There are other currencies are picking up, are being used for global trade, and the U.S. dollar is losing its is losing its influence and its power. Well, this is something else. I think if the dollar declines relative to, it's not in the short term, it's been stronger, but if it declines relative to other currencies, that's another very important inflationary measure for it will influence inflation in the United States very significantly. So on the geopolitical side, there's really growing hostility towards the United States. I mean, very few people realize, because the propaganda machine doesn't tell us, but NATO has 300,000 troops surrounding Russia right now. And Putin doesn't exactly like that. And we don't want the Chinese to be able to patrol their own sea lanes. China isn't very happy about that. So why would China keep buying our treasuries when we're at odds with them as we are, really? And then they have their own needs. China and Japan have their own needs, financing needs that they have to get out of treasuries. And just the general growth of the BRICS and their economies, and they're really pulling together their own, well, they're gaining influence at the IMF, so the U.S. voting power at the IMF is decreasing. And the BRICS, really, they're installing their own trade and banking infrastructure to compete and to compete with the West. And so these are all issues, I think, that are really starting to be important in terms of the dollar and the future of the dollar, and I think are probably very bullish for gold. And then just in general, as I said, I think there's a basic tectonic shift that's taking place just because markets get overpriced, and at some point in time, people start taking money off the table and they start moving into other things. So commodities are undervalued compared to stocks, you could argue. And I think the markets are starting to say that, actually, certainly with copper recently is maybe an indication of that. Again, I just mentioned this negative real rate of interest. I showed the slide again because I think it's the most important thing to keep in mind. Real rates of interest, the direction thereof. You can see that whenever real rates of interest, I mean, look in the 1970s when they went almost negative 6%. That's when that set off the gold bull market from 35 bucks to 850. And then you had these solid rates after Volcker hiked the rates. As I mentioned, my first mortgage is 17.5%. We had 16% treasury rates. And that killed gold. That absolutely killed gold. But how could they do the same thing now? It's very difficult to envision how they could possibly raise rates. Even, as I said, 5% takes us to $1 trillion a year in debt service. So now, with respect to the gold shares, and this was another slide that Paul Wong showed when we were up there, the newsletter writers that were invited there. This is back in September. This is a September slide, shows the price to cash flow multiple for senior producers. So you can see where we're at now, or where we were. Presumably it's lower now because of the fall off in the share prices. So price to cash flow for these mining companies, very, very modest right now, and certainly not overpriced. And you can see where it was in 2007. It was 20 times, and now we're looking at something between 5 and 10 times. And then the long-term equity to gold bullion ratio, you can see that as well. The equity prices to the gold bullion price is still well contained, very low relative to history. Now, I just mentioned Michael Oliver. I have him on my radio show almost every week because I found him as someone who doesn't trade, but someone who likes to look at the longer-term direction of markets, to be as good as anybody I've ever used. And he sent this out after the markets and the gold investors were rattled on Friday. And he's basically saying he doesn't buy the bear market at all. He's basically looking, he does momentum work, and his momentum work usually leads the price work. So if the momentum is showing an upward move, it's usually a week or 2 or 3 or so ahead of the prices of whatever market he's looking at. So he just said in his letter he sent out, he said, exit if you must, based on your own level of risk tolerance, or if your time scale or participation is short. MSA, that's his newsletter, defines trends, often intermediate and short-term ones in many markets. But in the case of gold, we argue that a long-term vista must dominate at this point in time for gold due to massive shifts undergoing in the other asset categories. And again, I mentioned this plate tectonics, this major market plate tectonics, he thinks, that there's going to be money coming out of the equity market, certainly coming out of the bond market now. And a lot of that seems to be going into equity markets because I really think, and I think another speaker or two here pointed out, that it was really that people aren't buying the inflation rate yet. They see the nominal rates for 20, 10-year, 20-year, 30-year bonds going straight up, and they're not factoring in, most people are not factoring in yet the rising inflation that's, remains to be seen, but I believe it's on its way. So I just mentioned some of the companies that I've invited to this show. Balmoral, they presented yesterday, so those of you who heard the story, but certainly the Martiniere gold prospect is looking really good, and they have an asset, the Grasset nickel cobalt asset that's very well advanced and really gives the company an underpinning of value, I think. But really the exciting part is the gold exploration along the Abitibi Greenstone Belt. Golden Predator, who will be talking in just a few minutes here. This is really an exciting story. They have the Brewery Creek mine, which is it has a PEA and it's very advanced and the economics look pretty good. They just recently drilled their best hole yet, but Bill tells me that basically they're not really focused on that because they're having so much excitement with their Three Aces deposit, just incredibly high-grade surface mineralization that they're finding there, and so he'll talk about that in a few minutes. Klondike Gold Corp, that's where the placer mines, the famous placer mines of the late 1800s, following the San Francisco or the California discoveries. They, a lot of people, or some people thought that there probably wasn't any hard rock potential there yet, but we'll learn from Peter here when he talks that that's not the case at all, that they have in fact an orogenic deposit that runs quite deep. The deposit isn't delineated yet, but there's all kinds of evidence that we will find out about the grades and so forth, but there's some really good signs. Some high grades have been, some high grade sniffs, and Peter will tell us more about that. Novo Resources is one of the most unusual stories that I've ever covered in the many years that I've followed, and Quentin Henning will tell you about that in a couple of minutes. It's the whole idea of how the Great Witwatersrand deposit was formed, and Quentin, being the naughty boy that he is, he had some ideas other than what Newmont had about how things could actually be. He's a free thinker, and he came up with this idea that it was a precipitation event, that it took place and could have taken place only about 2.7 billion years ago or so, when photosynthesis started to take place in the Earth's atmosphere and environment. So that's a very interesting story, and he's on to some very, very promising assays and exploration results, which he'll talk about. PPX Mining, really an interesting story in Peru. They're actually breaking rock and they're producing test mining now, and underground with lots of exploration potential, and they should hopefully have some cash flow very soon, and we'll let them talk about that in a minute. And Brian will tell us about that. RN Resources, I didn't invite. I think Gwen beat me to that invitation to bring them to the show, but it's one that I really like and have liked for some time, mostly because of the management, but they've really also brought on some very strong technical people, but they have the good mix of technical capabilities, the way they structure their deals, and their ability to raise serious money, and they're really looking at very large-scale projects, and I think it's a very interesting story, but they presented yesterday. Again, I just go back to this slide. It's really feast or famine in this business, and when times are really good, they're really good. It's never a straight line, but you see that the past, we've had some pretty severe pullbacks in those major bull markets, and I think what we're experiencing now is no different. But if you look at Paul Wong figures that we're just really in the very early stages of this bull, and certainly we've just seen a bit of a correction. This slide was in August, the end of August, from Paul when we were there. Again, this one I just show you again because I think it's the most important slide. The relationship between the direction of real interest rates and the price of gold, and also then, of course, the shares. So I think, it's hard, it doesn't feel it in your gut when you've gone through a week when you've seen a $100 drop in gold. But I believe that we are in the greatest bull market of my lifetime, and I'm not going to be around that. I mean, I'm one of the older guys up here, I think, probably pushing 70 next year. So I think we're close. I think we're going to see, I think this is the greatest bull market in my lifetime. And one of the major reasons is because it was 1971 when Nixon took us off the gold window, the gold standard, and the whole world then had no anchor to the amount of money it could create. That has led to this enormous amount of indebtedness relative to debt, relative to income. And it's also the idea that capitalism is being destroyed, so you have misallocation of resources. The debt is out there, but there's no cash flow to supply to service it because the bad investments are made when you put interest rates down below where they should be. So you know, gold is nature's money for reasons. It's always selected by markets when it's given a chance. And, you know, the politicians will fight it tooth and nail because they like to be able to issue counterfeit money and get rich and impoverish people who create the wealth. But, you know, there are limits to everything. There's limits in nature. There's limits in politics and markets. And I think that we're getting very close to that. So that's really all I have to say. I see I'm in the red for a minute, so I'll probably get a spanking. I'm going to say that's it for me. All right, just like you to go to J. Taylor Media and check out my radio show and all of that. So, all right, thank you.